Now, I'm not a financial advisor. I just have to throw that out there in the disclaimer here. But for your typical beginner in investing in stocks, I do not recommend going with individual stocks. I recommend going with funds, specifically index funds, but we'll get there. So you definitely want to stay watching till the end. So breaking down what a fund is in terms of a mutual fund, think about it like buying flowers. If you buy one flower, you've bought one stock. But if that one flower dies, you have nothing. However, if you buy a whole bouquet of flowers, you not only have one stock, you have a whole bunch of stocks that are all part of the bouquet. When you're buying into a mutual fund, you're usually buying into a whole collection of stocks that have been bundled into one price, and you pay $10 for the whole bundle instead of, $2 for that flower, $7 for this flower, $20 for this flower, $2 for that flower. It's just one price and it gets you all the flowers. Another way I've heard it described is like honeybees. Again, if you buy one bee and that bee dies, well then you put all this money towards your one bee, but now he's dead, you've lost it all. But if you buy a whole colony, a whole beehive, now if any one, two, three, a whole bunch of the bees don't do well, they've got all these other bees making up for it, so you're still getting your honey even though some of those bees haven't made it. But if you only bought one, it's a lot riskier. If that one bee does really well, hey, cool, but if that bee dies, you're in trouble. So I would say instead of buying individual flowers and bees, buy the bouquet, buy the beehive, buy the mutual fund. But there's a specific type of mutual fund that I recommend coming up. The kind that I don't recommend, now they're not all bad, some of them are good, but personally for beginners getting started, I would stay away from actively managed funds. The reason is because they have higher fees, usually around 1%. Now, a 1% fee doesn't sound like a lot, but if you look at it over the course of a long-term investment strategy, it can be a huge difference. Let's break it down and I'll show you right here. If you were to invest $100 over the course of 35 years, $100 a month for 35 years, you would end up at an 8% rate of return, around $206,000, a little bit more than that if that rate was consistent over that full time. If you had to pay a mutual fund manager 1% of that, then your returns actually are more like 7% instead of 8%, because that extra percent is actually being paid out each year to the fund manager. So now after those same 35 years have elapsed, instead of having $206,000 in your account, you only have about $165,000 in your account. That 1% annual fee cost you almost $40,000. And $40,000 compared to the potential $206,000, that's almost 20% lost. So while you're looking at 1% thinking that's not very much, but over the course of 35 years, that turned into over 20% loss that you're paying somebody else to manage your money for you. So over the long haul, it can really kill your growth potential. Which brings us to index funds and why I think they're a good way to go for beginners. And if you want more on this topic, you can watch the full video here, or you can go to my playlist down there, or to learn more about personal finance, investing, and building wealth, you can click below. And don't forget about my TikTok and Instagram at ThomasKnappFE. Find your path to financial freedom. Stay empowered, and we will see you next time.